Picture two people. The first starts investing at 23. Every month he sets aside a small, almost forgettable amount through automated investing, without willpower, without motivation, without ever making a big decision. It's just automatic savings running quietly in the background of his life while he goes on living it. The second person starts at 40. He earns more. He can afford a much bigger monthly investment plan. He feels more responsible, more disciplined, more ready than the first guy ever was. Here's the question this book answers, and it's not the one you think. Why does starting early almost always beat saving more later? This isn't about investing at 23 versus 40 as a matter of pride. It's about a single mathematical force that quietly decides the outcome before either person even notices: compound interest. Whether or not Einstein really called it the eighth wonder of the world, the mechanics behind compound interest explained with real numbers are simple, testable, and available to anyone, even someone starting with almost nothing. This is a 7-part system built the same way we'd build it for our own clients. Not just start today motivation. A clear, calm breakdown of why start investing early actually works, why small recurring investments aren't a magic trick on their own, what saving versus investing really costs you over decades, and how to build an automated monthly investing system that keeps running even when you stop thinking about it. One disclaimer before we go further. Every number in this book is illustrative, not a promise. No return is guaranteed. But the structure, time, consistency, decisions made early instead of late, works no matter what the exact annual return turns out to be. Quick question before we start. Which of these two describes you right now? Someone who hasn't started yet, or someone who started small and isn't sure it's enough? Keep that answer in mind. We'll come back to it. If this resonates, hit subscribe now. The rest of this system builds chapter by chapter, and each one only makes sense with the one before it. Let's begin. Chapter 1. Systems, not goals. If you've ever set a savings goal in January and quietly abandoned it by March, you're not undisciplined. You built the wrong kind of thing. Keep reading, because the fix is almost embarrassingly simple. Most people thinking about their financial future set a goal. I want 100,000 euros saved by 45, or I want a comfortable retirement. Goals sound inspiring. They give us a number to say out loud at dinner parties. The problem is that a goal points at a direction. It doesn't create action. It lives in your head, on a sticky note, in a New Year's resolution app you deleted by February. It does not live on your calendar, in your bank's automation settings, or anywhere that actually moves money. A system is different. A system is a repeated action that happens whether or not you feel motivated that day, whether your week was good or terrible, whether you remembered your financial habits, goals, or completely forgot them existed. This is at the heart of behavioral finance and behavioral economics research. People automatically enrolled in a savings or retirement plan stay in it at dramatically higher rates than people who have to opt in on their own, month after month, decision after decision. That tells us something simple and honestly a little humbling. The default option almost always beats willpower. Not because people are weak, because willpower is a finite resource and defaults are not. If your investing depends on remembering, feeling motivated, or finding the time, it eventually stops. Life gets busy. An unexpected bill shows up. and the "I'll do it next month" pattern quietly becomes the permanent pattern. If it happens through financial automation, right after payday, with no daily decision required, it keeps running for years, even when life gets messy, even during the months you're too tired to think about money at all. This is also the exact principle behind investing habits for long-term wealth. It isn't built from occasional bursts of motivation. It's built from boring, repeated automatic decisions made once and then left alone. Financial educators and behavioral researchers alike consistently point to the same finding. The size of the win from automation often outweighs the size of the win from picking a better investment. In other words, how you save matters as much as what you save into. The philosophy of this book is simple. Don't build a goal. Build a system that runs itself. This is the essence of automatic investing, and it's the foundation every remaining chapter builds on. Ask yourself, is your current plan a goal sitting in your head or a system already running in your bank account? Drop your honest answer in the comments. It helps more people than you'd think when you're specific about where you actually stand. If you found this useful, subscribe before Chapter 2. We're about to challenge one of the most repeated and most misleading pieces of advice in personal finance. Chapter 2. The Micro-Saving Myth. You've probably heard any amount is better than none 100 times. It's not wrong, but it's dangerously incomplete, and believing it too literally might be quietly costing you years. Here's the fuller picture. It's popular to say any contribution is better than none. That's partly true, but incomplete in a way that can actually mislead people into a false sense of security. Saying €10 a month counts without explaining why or under what conditions can leave someone feeling like they've solved the problem, when really they've only started a conversation with it. Small monthly investments carry real value, as a habit, as a starting point, as a way to test whether your system actually works before you commit larger sums to it. But the amount alone doesn't build meaningful wealth unless it's combined with three other variables: time, consistency, and real return after inflation and fees. Strip out any one of those, and even a heroic monthly contribution can underperform a modest one that simply had more time. A small amount without time is just a symbolic gesture, a nice habit, a good intention, a psychological win. A small amount with a 15 to 20-year runway is a serious financial strategy. This is exactly why any good compound interest calculator with monthly contributions lets you adjust 4 variables at once: starting amount, monthly contribution, time horizon, and compounding frequency. Change any one of those, and the outcome shifts dramatically, sometimes by tens of thousands over a lifetime. This is where a lot of well-meaning advice quietly falls apart. People are told to just start, which is good advice, but then never told the second half of the sentence, and then let time do most of the actual work. Without that second half, someone can end up disillusioned after 2 years of small contributions, wondering why their account isn't growing, when the honest answer is that compounding hasn't had enough time yet to become visible. This is one of the most common and most avoidable reasons people quit right before the curve starts to bend upward. Practical takeaway: don't judge your 20 to €50 monthly investment by what it buys today. Judge it by how much time it has left to grow. That's the whole idea behind monthly investing compound interest calculator tools in the first place. And it's the single most common thing people get wrong when they first start. A quick question for you. If you've been investing small amounts for a while and it doesn't feel like it's working, how long have you actually given it? Be honest. 6 months and 15 years produce very different graphs from the exact same monthly amount. Subscribe now if this chapter reframed anything for you. Chapter 3 covers the cost that almost nobody accounts for, and it might change how you think about waiting for a better time to start. Chapter 3. The cost of waiting, inflation and lost time. Most people think waiting is free, that the only cost of not investing is the money they didn't put in. That's only half true, and the hidden half is usually bigger. Let's make it visible. Waiting has 2 costs, and most people only see one of them clearly. The first cost is obvious once someone points it out. Inflation steadily erodes the purchasing power of cash sitting idle, not growing. A sum that feels safe today, tucked away in a low-interest account, may quietly buy noticeably less in 10 or 15 years. This is the core idea behind every honest benefits of automatic investing argument you'll ever read. The goal isn't just growth. It's keeping pace with a currency that is constantly losing a little of its value every year. The second cost is less obvious and often bigger. Every month you delay is a month your capital never gets back to grow. This is the part that doesn't show up on a bank statement, so it's easy to ignore. You can't make up for lost time later by simply contributing more, because a later contribution has less time left for monthly compounding to work its magic, no matter how large it eventually becomes. Time isn't a resource you can substitute for with money. It's the one input money can't buy back. To be fair, and this matters for staying credible rather than sounding like a sales pitch, not every investment automatically outpaces inflation. It depends on asset class, time horizon, fees, and risk tolerance. Cash under a mattress loses to inflation reliably. A diversified long-term portfolio has historically had a much better track record of outpacing it, but historically is not the same word as guaranteed, and anyone telling you otherwise is skipping an important detail. The real question isn't, what does it cost to start investing today? It's, how much does investing early matter, and how much am I quietly losing with every month I wait? Most people never run that number because it's uncomfortable. But discomfort is exactly why it's worth running once, honestly, with real figures instead of vague anxiety. Ask yourself this one, seriously. If you delayed starting by even 12 months from today, what would that month have been worth by the time you're 60 or 65? You don't need to know the exact answer. Just notice that the question has a real, calculable answer, and that alone changes how someday feels. If this chapter made you a little uncomfortable in a useful way, that's exactly the point. Subscribe and stick around, because Chapter 4 explains why so many people know all of this and still don't act on it. It's not about laziness, and the real reason might surprise you. Chapter 4. The Discipline Gap. Here's an uncomfortable truth. You probably already know everything in Chapter 3. Most people do, so why doesn't knowing change behavior? This chapter is about that exact gap, and it's not the gap you think. Almost everyone intends to save more. Ask a room full of people if they wish they'd started investing earlier, and nearly every hand goes up. The gap between intention and consistent action is rarely a character flaw, and it's rarely about intelligence either. Plenty of financially literate people still don't do the thing they know they should do. Almost always, it's a system design problem, not a person problem. Research on automatic enrollment into retirement plans shows something striking and honestly a little humbling for anyone who believes willpower is the main variable. When people are automatically enrolled instead of having to opt in themselves, participation rates can exceed 85%. That's not a small nudge. That's the difference between a plan mostly failing and a plan mostly succeeding, based entirely on how the choice was framed, not on how motivated the participants were. Most people simply stay wherever the default puts them, even when that default isn't optimal for their situation. That cuts both ways, and it's worth sitting with both sides honestly. Good news. Build an automatic savings plan once, and the odds you'll stick with it are very high, dramatically higher than relying on remembering to transfer money manually every month. Bad news. If your starting contribution or fund choice is set too conservatively, say a token €10 a month into a low-growth default, you can get stuck there for years because nothing naturally prompts a review. The same inertia that keeps you saving also keeps you saving too little if you never revisit the number. Practical takeaway: automate, but commit to one extra habit that most automation guides conveniently leave out. Review the system at least once a year. Not daily obsessing over markets, not checking your balance every time you're anxious. Just a calm, scheduled, once-a-year check to see whether your contribution still fits your income and goals. This single habit is often the difference between an automatic plan that quietly stalls at a beginner-level contribution for a decade and one that grows alongside your actual life. A question worth sitting with. When was the last time you actually looked at your savings rate as a percentage of your income, rather than just an absolute number that felt fine 5 years ago? If you can't remember, that's not a failure, it's just information, and it's exactly what this chapter exists to fix. Subscribe if you want the rest of this system laid out clearly. Chapter 5 is the one most people share with a friend, because it's the actual head-to-head math between starting at 23 and starting at 40. Chapter 5. Investing at 23 versus 40, where the real power lives. This is the chapter people screenshot. If you've ever wondered whether it's too late because you didn't start in your 20s, read this one carefully before you draw any conclusions. This is the central calculation of the whole book, and the golden rule for comparing two investors fairly. Hold every other variable constant. Skip this rule, and the comparison becomes meaningless marketing rather than an honest illustration. Imagine two people with the same expected annual return, the same monthly compounding frequency, and the same end date, say retiring at 65. Investor A starts at 23, contributing a smaller but consistent amount as part of a monthly investment plan for 42 years straight without interruption. Investor B starts at 40, contributing a noticeably larger amount every month specifically to catch up, but only has 25 years for that money to grow. The math is blunt, and this is the part that tends to surprise people who assume more money in always wins. Even though Investor B puts in far more money every single month, sometimes 2 or 3 times as much, his total often ends up smaller than Investor A's. Why? Because A's capital had 17 extra years to grow exponentially instead of just linearly. In the early years, growth looks almost flat and unremarkable. In the final stretch, it accelerates in a way that additional monthly contributions started late simply cannot fully replicate. This is the entire logic behind compound interest, early versus late comparisons, and it's why time in the market so often beats timing the market or trying to out-contribute lost years. This doesn't mean starting at 40 is pointless, far from it. And it's important to say that clearly, so this doesn't come across as discouraging to anyone in that exact position. It means every decade you wait raises the amount you'll eventually need to contribute to reach the same result. And it makes the decision to start right now, at whatever age you are today, meaningfully more valuable than starting next year. This model is illustrative. Real market returns fluctuate, fees and inflation affect outcomes, and no historical performance guarantees future results. It's meant to answer, does starting early really beat investing more later, not to promise a specific number for your own situation? Here's a question for the comments. Which age are you closer to right now, 23 or 40? And does this comparison change what you plan to do this month? Not someday, but this month. If this comparison surprised you even a little, subscribe. Chapter 6 turns all of this theory into an actual system you can set up this week, not just understand in principle. Chapter 6: The Automated Contribution System. Understanding compound interest and actually having a system that uses it are two very different things. This chapter is where the theory becomes something you can turn on today. An automatic transfer right after payday is one of the simplest, most underrated ways to fight procrastination. When the money moves before you have a chance to spend it, the decision gets made once, not relitigated every single month, not dependent on how much willpower you happen to have left after a long week. But let's be honest about its limits, because overselling automation is exactly how people end up disappointed and give up entirely. Automated monthly investing is not a substitute for a real budget that accounts for your actual spending, an emergency fund that keeps a bad month from becoming a bad year, properly managing existing high-interest debt, a genuine assessment of your personal risk tolerance and time horizon. Skipping any of these and jumping straight to automation is a bit like installing a sprinkler system in a house with no foundation. It might look impressive, but it's not solving the actual structural problem. Research on automatic enrollment and choice simplification shows real, measurable benefits for retirement savings. The data here is genuinely strong, not just motivational poster material. But newer data also offers an important, less quoted warning. Long-term impact weakens when people switch jobs and forget to carry contributions forward, when people cash out early during a financial emergency, or when people never increase their contribution over time and simply let inflation quietly shrink its real value. Automating an automated investing strategy for beginners is step one, a genuinely important one, but not the entire plan. A practical three-step system model you can realistically set up this week. 1. First, build a minimum liquidity buffer, your emergency fund, so a single bad month doesn't force you to break the system you're about to build. 2. Then, set up a consistent recurring investments transfer that happens automatically right after payday before you see the money in your regular spending account. 3. Once a year, make a conscious, scheduled decision. Can I increase the contribution this year, even slightly? Question for you. Out of budget, emergency fund, debt, and automation, which one is currently missing from your setup? Naming it honestly is usually the first real step toward fixing it. Subscribe now if you're planning to actually set this up. The final chapter pulls everything together into a simple, repeatable checklist you can revisit anytime you feel off track. Chapter 7. Summary and Next Steps. You've now seen the full argument, the system, the myth, the hidden cost, the discipline gap, the head-to-head math, and the mechanics. Here's how it all fits together in one place. If you take away only 4 sentences from this entire book, let them be these. 1. Start earlier, not bigger. Time in the market usually matters more than the size of any single contribution. This single idea undoes most of the anxiety around not having enough to start. 2. Automate intelligently. A system that runs without your daily willpower beats even the strongest motivation on its worst week every single time. 3. Increase contributions as income grows. Automation is not fully set it and forget it. Periodic review is essential to real long-term wealth, not just a nice to have. 4. Check the system regularly. Does the contribution still match your income? Is the risk appropriate for your actual timeline? Is the hypothetical 7% return you're assuming actually realistic for your chosen investments, or just a number that felt good to plug into a calculator? Automatic savings aren't magic, and nobody should pretend they are. They're an honest, mathematically verifiable structure, one that works best when you check in on it occasionally, rather than abandoning it completely to autopilot and hoping for the best a decade later. If you're asking yourself, is it too late to start investing at 40, or can I catch up on retirement savings after 40? The honest answer, backed by everything covered in Chapter 5, is no, it's not too late. But the sooner you start today, the less you'll have to make up for tomorrow. That sentence alone is worth more than most of the vague encouragement floating around online. One last question before you go. Of the 7 ideas in this book, which one are you actually going to act on this week? Not someday, this week. Write it in the comments. Saying it publicly, even to strangers on the internet, measurably increases the odds you'll follow through. If this system was useful to you, subscribe and turn on notifications. The next video breaks down a real step-by-step example using actual numbers, so you can see exactly how this looks when it's not hypothetical anymore. Outro. If there's just one thing to do after reading this book, let it not be, I'll invest more once I have more money. Let it be one small, concrete, automated action, a recurring investment that happens whether or not you remember to think about it tomorrow. The 23-year-old investor in our example wasn't richer, braver, or smarter than the 40-year-old. He simply had one thing money can't buy back: time that had already started. Your time has already started too. The only real question is the system that will use it already running? Or is it still waiting for your someday? Before you go, subscribe, drop a comment with your age and where you're starting from, and share this with the one person you know who keeps saying, I'll start next year. Every one of those actions genuinely helps this channel keep making content like this. And none of it costs you anything more than 30 seconds. Sovereign asset systems. If this shifted compound interest early versus late? Question, subscribing helps, and the Millionaire Mindset Mastery playlist on the channel homepage continues the series. If this was useful, you're welcome to subscribe to this channel. This has been an educational production of the Peter A. Saul Media Trust and Mindset Audiobooks Mastery. Thank you for listening. The calculations and examples in this book are illustrative and reflect the author's perspective and general research on behavioral finance, not individual financial investment or tax advice. Past or hypothetical performance does not guarantee future results. Consult a licensed financial professional before making investment decisions.